This is a series in our lean finance sessions on valuation. We want to touch upon in the next couple, in several different sessions, just some key things about valuation, especially with early stage companies. What we'll talk about briefly is why we value, what types of things we value, also the differences in valuation between from early stage firms, startups and so on, all the way through mature firms, companies with revenues, profits, older firms, and different techniques that apply to it. Three things to note, and again, this kind of comes from out of Harvard Business School, Bill Solomon and other entrepreneurial finance professors, is the difference between worth, value, and price. When you get into valuation, remember that each person, the buyer or the seller, the investor or the entrepreneur, is going to feel the asset or the business is worth something to them. So when investors have to think about it, they have to provide, well, what's it worth it to me if I invest in it, if I control it, if I manage it? So if I were to run the operations or hire people to run the operations, what's it going to be worth to us as an investment team? However, as we know a lot of times that the real value is not necessarily what we think it's worth, because there can be a huge difference between a seller and buyer, but more of what's the market value the asset at? What's the market value? We always like to use the car or the house analogy. One of the ways you value a house that you're looking at buying is, comparables. You try to see houses that are similar in the same neighborhood, in the same region, that recently sold or were bought. What was the price on those? What were the terms of the price? What was the asking price versus what it actually was sold for? So in other words, what's the market value at? And then finally, there's this thing called the price. Remember, price is what ultimately gets paid, what's negotiated between buyer and seller. And the key thing is that there's that difference, that market value, worth, and price are not all going to be the same. The big thing why we go through the valuation and developing a worth type estimate is just to give us a sense of what would be a ballpark price when we start negotiating. Also remember, when you get into determining a price for an asset, for a business and investment, that it's not necessarily the dollar amount of the price, but also includes the terms, like what's the timing of the investment, how is it going to be financed, through loans, through preferred stock. Are there going to be incentives? What's going to be control as far as board seats and things of that nature? So those all come